Boa tarde a todos, é um prazer tê-los aqui, agradeço a presença massiva. Bom, essa tarde a gente vai ter um seminário, nós vamos estar vendo 8 apresentações, né, divididas em 2 metades, em 2 sessões. Né, cada apresentação vai ter até 25 minutos, então eu vou estar ajudando os apresentadores, quando faltar 5 minutos eu levanto um papelzinho. E eu queria agradecer, em primeiro lugar, então, a presença da Roberta Terranova, pesquisadora na Universidade Côte d'Azur, da França. Ela vai estar apresentando o primeiro paper aqui dessa sessão. Então, Roberta, please, the floor is yours.
Okay.
Please be welcome.
Thank you. Thank you, Marcelo. Thank you for organizing this, and thank you for being here. So I will present this work, which is titled Negative Emissions, Positive Returns, How Financial Markets React to Carbon Removal Purchases, and it's co-authored with Francesco Lamperti and Massimo Savoni. So this is a work in progress, so any comments is welcome. So this is an empirical work, and as a motivation, actually so I think we are all familiar with the need of reducing emissions to mitigate climate change. And in this picture, what we see is the of the emissions which is needed to stay within the 2 degrees increase in global temperature. And this comes from the climate scenarios from IPCC and so on. But what I will focus on is this part of negative emissions. So basically what we see is that very soon, like before 2030, according to these climate scenarios, we should start having these negative emissions, and they should increase over time. And in particular, at some point, we will need to have more negative emissions than how much CO2 emissions we emit in the atmosphere. This means that we need to remove, basically, CO2 from the atmosphere. So this need of large removals, so large quantity of CO2 that needs to be removed from the atmosphere, and the existence of carbon emissions, so there are sectors that are really hard to abate, and implications for the large interest in this carbon dioxide, which is CDR methods. And for example, here we see this New York Times cover on this scrubbing carbon from the sky, which is exactly this CO2 removal. And at the same time, there is an increasing demand on the part of firms for these carbon credits, which I will explain in a while, linked with the permanent carbon removals. For example, we have this news on carbon credit demand prices, and then this is an example of Microsoft, which is one of the companies that is most active in these markets of carbon credits. And here we see exactly Microsoft demanding more and more these carbon removal credits. So just to explain very briefly what is a carbon removal credit, is a certificate for 1 ton of CO2 reduced or removed. For example, there is a project which removes CO2 from the atmosphere, and this generates credits, the corresponding amount of credits. This project can be either, I don't know, reforestation, afforestation, but they can also be more technology-based projects. So there is, for example, direct air capture or biochar. And then these credits can be used on 2 possible markets. So one is a compliance market. Basically, it's like the emission trading system. I don't know if you know it. So where firms buy permits to emit or credits, and then because regulation requires these permits or credits. And then there are the voluntary markets. So in these voluntary markets, firms buy these credits by choice. So not because they have to, but because maybe they have internal climate commitments or for reputational reasons and so on. So, however, if we talk about removal credits, so credits associated to removing CO2, the most important markets are the voluntary markets, because often in the compliance markets they don't accept these credits, or there are strict limitations. So we will focus on voluntary market, and we will focus on carbon removal credits, so not on reduction credit removal. And this is just to show you, so this is from our data set. We have the number of transactions, so of these purchases, and the number of tons that are purchased, so the number of carbon credits that are purchased. And we can see that from the 2015, these are increasing. There are lots of fluctuations, but in general we see a clear increase in these transactions. So let's say more theoretical is that, so we saw that there is this increased demand for carbon credits, and firms are funding more and more. And also we know that the financial markets are not blind to climate risks, in the sense that there is evidence of a carbon risk premium, there is a positive market reaction of firms going green. So in general, financial markets know about climate risk and react to it, and corporations can react in many different ways to transition risks and to climate change and so on. This paper showing that corporations face high transition risks, the first thing they do is not mitigating emissions, but first they try other strategies such as lobbying and other things. This literature showing that corporations are buying more and more removal credits to compensate their emissions. So in this context, we want to know how financial markets react to carbon removal purchases, so whether investors appreciate this strategy or not. So our data is the following. So we have the carbon credit transactions from two datasets. One is allied offset and one is the CDR FYI, and then we download stock prices data from Yahoo Finance. So in the end, we end up, so we focus only on the buyers of these carbon credits, which are public, like listed companies, of course. We want to know the investor data. And we end up with more than 400 public buyers. And then we have the number of transactions that we have is more than 5,000. Then we need to cut a bit this data. I will explain it. So our data set starts in 2010, and it ends up in 2025. Okay, so I will just show you this data set, some descriptive statistics. So these are all the transactions that we have with the disclosed buyer. So here we know who is the buyer, and so there are some individual acquirers, so like private people, and some private companies and some public companies, and these are the total cost purchase. And we focus on public companies, as I said. And again, to give you an idea, so we have top purchases by top purchase. So we have Microsoft, by far, as I said, is by far the biggest acquirer. And then different acquirers or oil and gas companies, Google. I mean, it's very diverse buyers. And as I said, we focus on the public ones. And here, this is just companies taken to give you an example and an idea of the data that we match. So we have the stock price, which is the time series, and then the red vertical lines indicate when a transaction happens. So when this company buys a carbon credit in this voluntary market. So then we use this information, as I will tell you. And because we want to know, we want to study the reaction of the financial markets, one important thing to verify is that these transactions are so the investors have access to information. This is so here I show you that it's like this, because here we have news reporters on Google buying carbon removal from an Indian farm, and this is another website where it's a platform where you can buy carbon credits, and it's all information, for example, how much is buying from which project, and also the methodology underlying this project. So it's public information. So to study this, we use an event study, a short-run event study, which is standard methodology to study this financial market reaction to corporate action. So what we do first, to try to compute the normal excess return. So we use the 5 factors model from Pham and French, which is quite standard. Then we also do other robustness tests, and the results are robust. So the 5 factors model, so we have the excess return of, we compute to estimate the normal excess return of the firm buying a carbon credit on the day that this firm buys the carbon credit normal. So we compute for this firm in this day the normal excess return, which is the excess return, the factors, the value factor, the preferred factor, estimate the coefficients of the beta of the 5 factors. So we take each transaction in our data set, for each firm in each transaction, we take a window of time, so we go 200 days, from 200 days to 40 days before the transaction, and we use the data in this window of time to estimate this beta. And then we use these estimates to compute the normal excess return of the day of the transaction and the day before and the day after. So then once we have this normal return, we want to compute the abnormal excess return on this day of the transaction, the days before and the day after. So what we do, simply we take the return, the effective excess return, and to be the normal excess return, and then we have our abnormal return. Then we make sure that we keep only those transactions for which the estimation window is clean, so there are no other events in this estimation window, and we end up with the 600, more than 600 events. Then we have the abnormal return on the day of the transaction, the day before and the day after, and what we do is compute the average of normal return, and this gives us our measure of how the markets reacted to this transaction. This is, in the short run especially, very robust, quite standard. And then we test it. And we do this in this window. So we want to know what happens in -1 + 1, so 1 day before, 1 day after, 1 day before, 3 days after, and so on, to see how this market reaction evolves over time. Okay, so now I will show you the results. So just to say that when we did this study, we were expecting either non-significant results or positive reaction of the market. And instead, we find that for the full sample, so all the transactions that we have in our sample, we find this cumulative average of normal return to be actually significantly negative. And for example, in particular from the -3 days window, so up to 1 week after the transaction, the effect, the reaction of the markets is quite negative. And the magnitude of the effect is not huge, so we have something like that goes until -0.75%, so it's not a huge reaction, but actually it's not even a small one, because these transactions normally are quite small, like they don't buy a lot of carbon credits. And just to give you the economic meaning, so as I said, take the example of -0.75%, that means that the real return around the event is 0.75% percentage point lower than the counterfactual return after the event. Like average normal daily return of %, and this means if we take into account our event, a normal firm would have actually a negative cumulative return in this period. So it's, let's say it's non-negligible. Okay, so now we saw that for the full sample, market react negatively to this transaction. We want to understand why. So we do this analysis where we split the samples according to who is, so the buyer, the purchaser, what is bought, so the type of credit that is bought, and how is bought in the sense some features of the transaction. Okay, so who buys? We see the buyer sector and the buyer quality. Things are that, in particular, in the buyers in the information technology sectors are the one most penalized in the market, from the market, and also real estate. And here the magnitudes are quite larger than the full sample, of course. But maybe more interesting is this. So the data have some indexes on the buyer policy quality. What does it mean? This means that, sorry, the buyer quality, meaning that they put together some information on the climate commitments of the buyer. So you have buyers that have internal targets of emission reductions, and according to the data on these targets, we define this buyer quality, and we see that the financial markets are able to distinguish between buyers that are more credible, that have more credible climate policies, internal climate policies, and buyers that are less reliable, let's say, and these are more penalized. Then here we distinguish between removal types. So there are some removal methods which are mainly afforestation, reforestation, and there are some methods that are technical. These are more like novel methods, less established, and these are like direct air capture, biochar, so more technical, more less established, and potentially less certain. Here, the financial markets penalize much more the technical ones that are more novel and, as I said, maybe less reliable. And then project quality. Here it's a bit more mixed, but it seems that also the investors are able to distinguish between project quality, so the project of the removal. And here we split the data sets based on the how much is purchased and the intermediary. So the price, again, mixed here. So we have a transaction with a lower than median price, transaction with high price. It's maybe the high price is a bit more negative. This is the credit side. So smaller transactions are much more penalized by investors than large ones. And then intermediate. Buyer, you can buy these carbon credits on different platforms. So there are different intermediaries. What's nothing is that for this intermediary gold standard marketplace, there is a somehow positive effect, and we signal it because it's one of the few findings where we see a positive effect. Okay, then we do a lot of robustness tests. In general, the main findings hold, so the average effect is negative, and also this subset analysis holds, as I showed you. So then the next step is to see, to study a bit more quantitative what drives this financial market reaction to carbon removal purchases. So to do this, we want to explain this cross-transaction variation in cumulative abnormal returns around each carbon credit transaction event. So here, for this analysis, our unit, let's say, of analysis is for each transaction the cumulative abnormal return. So we don't look anymore at the percentage, we just take the cumulative abnormal return of each transaction. So the main variables are the log price of the transaction per ton. This is how much the tons purchased in that transaction over the emissions of the firm. So it's the relative, yeah, okay. And then this is the proxy carbon credits, and then we have a set of control level, and also have fixed effects. So what we find is that the price impact on the so on the financial while the size of the credit purchased over the emissions of the firm has a positive impact on the financial reaction. Then we have many fixed effects, also including the sector fixed effects, and here we just show the significant ones. So we have a negative impact of energy, real estate, and utilities compared to the omitted sector, which is the sector. So again, just these numbers, what we see is that the negative effect of the transaction price, to make understand, is like if a transaction has a return of minus 0.5%, which is the average that we find, an increase in the transaction price, so the transaction price increasing from the 70th percentile to the 20th percentile would bring the normal return to minus 1.13%. So this effect, the price is not so small, while the effect of the purchase volume intensity is smaller, and it's positive though. Okay, so I will conclude. I don't know how I am with the time, but okay, so what we did is that we see that corporations increasingly manage their emissions and commit to net zero strategies, and they increasingly do so with these carbon removal credits. So that we study how financial markets price these. Find is that investors see these firms' purchases and see this strategy of mitigating emissions, but on average, taking the full sample, they evaluate this strategy and like significantly negatively. And we also show that the investors are able to distinguish between characteristics of these transactions, and in particular for novel removal methods, so the more technical ones, the reaction is more net, so these are more penalized. Also, low quality buyers and low quality projects are even more penalized by the financial markets. Okay, so that's it.
A little bit of the fact that we have some questions now, and then later on we can also have more questions. So, if anybody wants to do some quick questions to Greta? No? Yes, please go ahead.
So, thank you for and just can you quantify what you mean by the quality of the project and how you measure it?
Yeah, so
change this one is not working.
Okay. Thank you. Yeah, so both for the buyer quality and the project quality, these are indices provided, indices that we build based on information provided by the allied offset, which is the data provider. So so for the project quality, they have a number of like really many variables, saying, for example, if the project was certified, because there are many ways in which you need to certify a project. There are also many agencies that check for each project whether they comply with certain requirements or not. So we have these variables indicating all of this for many projects, and then we combine this information in this index. So this is it basically. This is for the project. For the buyer, instead, is more related to if the company has an internal target of emission reduction, what is the target year of this emission reduction, what is the target, and so on. And I don't remember if you asked. No, this was the question. Okay, thanks.
Bom, boa tarde. Eu vou começar em português e aí mudar para o inglês, tá? Gente, boa tarde. Bom, obrigada pelo convite, né, Marcelo, a Camila também estava ajudando a organizar, o pessoal do CEA. É que eu estou ouvindo a minha própria voz, mas vocês não estão ouvindo com o microfone. Tá bom, eu vou falar mais alto. Obrigada pelo convite. Essa é uma apresentação que eu já fiz na UFRJ, so sorry for those who already saw it, mas talvez traga coisas novas para quem não teve contato ainda. E eu vou só pedir desculpa porque eu vou ter que sair às 4 porque eu tenho aula, tá? Então, enfim, qualquer coisa a gente conversa em outro momento. So now switching to English, this is a presentation on conflict inflation and the Phillips curve, thinking about these concepts in an agent-based framework. So it's quite different from the previous presentation because it's much, much more theoretical. I'm here trying to be part of a theoretical debate and not so much an empirical debate, and especially in relation to the post-Keynesian literature, but using a methodology that will appear in other presentations as well today. So basically from the post-Keynesian view, inflation is seen as the result of a distributive conflict. So basically we have different groups with different claims over income, and these claims are not consistent between each other. And how they become consistent is in an ex-post matter through inflation and other processes as well. So this is the post-Keynesian view of inflation. It's a bit different from the it's very different from the mainstream view, but it does have some similarities with Blanchard's view of inflation to a certain extent. And this approach generates the Phillips curve under certain assumptions. So again, some connection with the more standard discussion about inflation in terms of the Phillips curve. And basically what has been argued in this post-Keynesian literature is that different assumptions about how the economic process occur leads to different versions of the Phillips curve. So when I talk about different versions of the Phillips curve, I'm talking about the original Phillips curve, where the level of the inflation rate is associated with the level of unemployment, versus the accelerating curve, where it is the rate of change of inflation, so accelerating inflation, that is related with the level of unemployment, and this generates the concept of a NAIRU, which is the non-accelerating inflation rate. So we have these two versions, both in the more heterodox approach and in the mainstream approach, and in the heterodox view, different assumptions about the bargaining process and so on lead to different versions of the Phillips curve. So most of the post-Keynesian literature, but also of the mainstream literature, has been discussing this issue using aggregate models. So in the heterodox approach, there is very little discussion about what type of micro foundations could lead to the aggregate results that we normally discuss and that we learn in our courses, for instance. So the aim of this paper is to explore this gap in the literature by exploring two different research questions. So the first one is to check whether the main conclusions from the conflicting claims inflation approach from the heterodox literature, if they also hold when we have a model where most of the results at least are created in a bottom-up manner using realistic micro foundations, so using an agent-based framework. And the second research question is, under which conditions do we generate different versions of the Phillips curve? More precisely, when does the original Phillips curve loses its validity? So I should say that there is a big debate also in the mainstream literature about these changes in the Phillips curve, and they have certain hypotheses for that. So here I'm trying to also explore part of this, or other reasons for this change. So why do I want to do this? So basically, one thing is, I think it's interesting to explore the robustness of the conflicting claims inflation model from the heterodox literature. It's a very rich type of understanding of inflation, and showing that it is robust is a way to make it a stronger argument from it as well. So, and I also think that there is a lot of connection between how some post-Keynesians think about many things and how they appear in the more agent-based literature. So here, there is some, Bolton is one of the founding authors of this approach to inflation, and he argues that there is some space for uncoordinated markets, different types of agents, power being important, and this has connection with what appears in many discussions in the agent-based literature. So maybe there is a connection between these two literatures that can be made, and there are other people that have been trying to do this in this direction as well. Also, I think there is a space for providing a more realistic dynamics for inflation in agent-based models. So now there is a larger literature doing that, but a couple of years ago, when inflation wasn't so much like on the news and so on, it wasn't so much discussed. So maybe this is also a space for contribution. And then finally, contributes to this literature on the different natures of the Phillips curve, especially the heterodox approach, by exploring one factor that this literature usually does not explore because of the method that is used, which is agents heterogeneity. So I'll be looking at the transition from the accelerationist Phillips curve to the original Phillips curve. So in order to do so, I'll use the agent-based macroeconomic model that I have been working with since my PhD dissertation. So it has different versions. This is the latest version. And in this latest version, I've revised a bit the model to include more evidence on individual bargaining and individual wage negotiations based on surveys. So I'm trying to make the model structure more realistic in order to use it to explore inflation. Okay. So this last paragraph is more, when I present this to the post-Keynesian group, they usually are not so used to thinking about micro-foundations, and they usually associate micro-foundations with DSG models. And here I'm just arguing that we can use realistic micro-foundations that make sense in terms of what we see empirically, of being reasonable and so on. And this seems to be coherent with how even post-Keynesian models are framed. So this is the model. I'll go very briefly on its description. So basically it has 5 sectors, but most of the sectors are actually aggregate sectors. So the bank is an aggregate sector. It provides loans to certain firms, and it also holds deposits of all agents. There is a public sector which is aggregate as well, and it hires some of the workers, but it also collects taxes and pays unemployment benefits. And then there are the 2 types of firms which is quite standard in many macroeconomic agent-based models. So one of them is the consumption goods firm. It produces consumption goods, and it is a monopolist, but it sells these consumption goods to the capital goods. It sells the capital goods to the consumption goods firms, which are heterogeneous. So I have a heterogeneous set of consumption goods firms, and both types of firms will hire households which are also heterogeneous. So I have households that are heterogeneous in 2 different ways. One is that households can belong to 3 different classes, so capitalists, indirect workers, and direct workers, but also within each class, households are heterogeneous. So there's plenty of heterogeneity in the household sector, and this creates some dynamics in income distribution, which is not really the aim here, but it's also something that can be explored. Okay, so I'll basically explore the features of the model that are interesting for the research question that I'm dealing with. So I'll present some evidence on certain features and then explain how I have incorporated them in the model. There are two issues with that. First, that is not always easy to incorporate this evidence into the model, so sometimes this process is not perfect. And the second one is that many times we don't find the surveys that we want. So there are certain questions that I would like to know the empirical answer that I couldn't find, and then I had to kind of have hypotheses about the relations in order to be able to complete the model. So the first one is on firms' price and wage adjustments. So price and wage adjustments from the point of view of firms. So the first thing is, how do firms respond when they suffer an increase in wages? This evidence shows that they tend to try to cut other costs, they tend to increase prices, and they also reduce profit margins. There are other types of responses as well, but these are the three most important ones. So at the macro level, we would see wage increases having a partial pass-through to prices, but also a partial pass-through to income distribution because the markup changes. So we have these two different effects. We also see that inflation is the most important driver of frequent wage adjustments, and almost 1/3 of firms do adopt a certain internal rule in order to correct wages to inflation. This can be formal or informal. I think in Brazil this percentage is much higher because we have a history of high inflation, so this data is not for Brazil. But there is some evidence that firms are looking at inflation when bargaining wages or deciding wages. The majority of firms will consider in these decisions the past inflation rate, so they are actually correcting what wages lost in terms of purchasing power instead of trying to protect wages in advance, which seems coherent with what we see in terms of wage negotiations. So that is the evidence that I could gather in terms of price and wage adjustments. So based on this, in the model, I will assume, that increases in unit labor costs may or may not be passed on to prices. This depends on the flexibility of the markup. So depending on the value of this parameter, wage increases will be passed on 100% to prices, or they will be passed on just a certain percent because the markup will be adjusted downwards in order to absorb this wage increase. So this is one of the features of the model. I also assume that firms' desired wage. So firms have a desired wage, which is the one that they want to pay, and they will bargain with workers. And so the wage may or not be exactly their desired wage. But this desired wage can be indexed to inflation, depending on the value of the kappa parameter here. So firms may anticipate this indexation, or they may not.
That's a clarifying question. Because why do the variation of the cost and the pass-through affect the markup and not more like that you have the unit cost and you have your desired markup, and so it's not really the markup that change, but it's something that's affecting the variation of the cost. Because in principle, if you have a variation of, let's say, 10 in the cost and the markup is the same, you could pass all of it by keeping the markup. So this seems that you're changing the markup.
Yeah, exactly. So that the 10% is not entirely passed on to prices, because the idea is that when firms, and this is what the literature shows, when firms suffer a wage increase, they will try to avoid passing on everything to prices because they can lose competitiveness. So it's kind of a way to protect themselves in terms of competitiveness ex ante before they actually lose it. So that's the idea.
Do you have a question?
No, not here, but the price is the markup, which is also based on competition factors, and the second. So the markup is complex, but this is only one factor. Yeah. So in terms of workers' desired wages and on-the-job search, the evidence shows that a probability of job loss and a personal unemployment history tends to be associated with lower wages. There is also evidence that workers engage in on-the-job search, so they are employed, but they are looking for new positions. And this search effort will decline with their wage level. So if a worker is satisfied with his or her wage, he or she won't be looking for a new job. So based on this, it is assumed that employed workers always desire a real wage growth, which is given by this gamma parameter, and unemployed workers will slowly revise downward their desired real wage growth, actually their desired real wage. So they will tend to accept lower wages with time, according to the number of periods for which they have been unemployed. So this is what the equation is showing here, this type of adjustment. Employed workers may look for a new job if the wage offered by their current employer is lower than the average wage in the economy, and they will accept any offer as long as it's above the wage that they were offered by their current employer. And unemployed, so since there is certain degree of downward nominal rigidity, unemployed workers do not consider, or even employed workers do not consider negative inflation rates when they are thinking about their real wages. And there is this reservation wage, which is basically the unemployment dole that is offered by the government. So this sets the floor to nominal wages in the okay, so finally, in terms of the labor market and wage bargaining process, the evidence shows that fully decentralized and individualized bargaining is not so common, but we did see a shift towards decentralization of collective bargaining. So what we tend to have now is local bargaining at the firm level, and this occurs despite of the decrease in unionization. So this is not so much the case of the US, where individual bargaining is much more relevant, but it is the case when we look at a broader set of countries. Okay. We see some evidence that unemployment may be a factor influencing the bargaining process. And we see also evidence that wages that are collectively bargained, they tend to apply also to newly hired employees. So there's kind of a wage structure within firms with some variations, but this wage structure tends to be applied to all workers. And also evidence in favor of downward nominal wage rigidity. And in countries where there is larger union density, we also see downward real wage rigidity in the data. So based on this, I'll be assuming that nominal wages cannot be cut. Wages are decided at the firm level, and in the baseline scenario, the firms will be deciding wages, but they will be looking at one information from the market, which is the average of the desired wage of a sample of workers. And the wage will be the weighted average between the wage that the firm desires to pay and the wage that the set of workers would like to receive. And the weight given to the wage desired by workers will depend on a structural parameter, which is this fee, and on the employment rate from the past year. So two factors that may affect workers' bargaining power: the institutional framework, which is the parameter, and the cyclical factor associated with unemployment rate. Yeah. Mm-hmm. No unions. No, not in this range. Yeah, it's only firm levels. New employees receive the same wage as those who were already in the firms. There is no individual bargaining directly, only collectively, but at the firm level. I have 5 minutes now. Shoot. So the model is simulated for 300 periods. We'll only consider the last 200. And there are 100 Monte Carlo runs for each scenario, and I'll take the average of those runs to analyze the results. So in terms of the first research question, which was on conflict inflation and microfoundation, basically I'll try to see whether two conclusions from the conflicting claims inflation model are observed. If there is a relationship between the level of inflation and the degree of disagreement between workers and firms, which is one of the features of this model, and if wage shocks are partially translated into price and distribution effects. So, so this is one of the results. As we see here, when the gamma parameter increases, this means that there is more disagreement between workers and firms. And we do see that this translates into higher levels of inflation, as would be expected in the conflicting claims inflation model. And this also creates a Phillips curve. So here, the Phillips curve is non-significant. But then, once the parameter increases, we do see the emergence of a Phillips curve, so a negative and significant relationship between unemployment and inflation. And then, when we have a wage shock of 10% to 50% of the firms, we see that there is an increase in inflation rate, as would be expected. There is also a distributional shock, so an increase in the wage share, which is temporary, but there is this distributive effect as well. So basically, what this evidence is showing is that, first, there is an association between the degree of disagreement or conflict between workers and firms and the level of inflation, and that also we have inflation dynamics being followed always by distributive dynamics as well. So when we talk about inflation and distribution, they are always connected. So this is the, can I, 3 minutes more maybe? Okay, so this was the first question. The second one is the debate in terms of alternative versions of the Phillips curve. So I will skip this slide because it's really the theoretical discussion that has been going on in the post-Keynesian literature. But I'll show you one piece of information that is interesting, which is the degree of heterogeneity in terms of wage adjustments. So when we look at the Brazilian data, we see that in 2010, 7.5% of wage adjustments were below the inflation rate, while 81.7% were above. And then in 2015, 18.5% were below the inflation rate, and only 61.5% were above the inflation rate. So there are two interesting things here. First, there's heterogeneity in terms of the degree of indexation in wage adjustments, and second, the percentage of firms for which the wage adjustments are above inflation changes with time and also changes in the economic cycle. So 2010 was a year of high economic activity. Many firms offered wage adjustments that were above inflation. 2015 was a year where economic activity was decelerating, and then we have an increase in the number of wage adjustments below inflation. So this shows the importance of this type of heterogeneity in terms of wage determinations, which has implications for inflation dynamics as well. So here I will test two wage bargaining frameworks. The first one is the one that I have just presented. And the second one is the more collective bargaining approach, where firms are directly negotiating wages with their workers. So they are negotiating wages with their current employers, and there is a two-step negotiation. So first, they decide on the level, the degree of indexation to past inflation. And only if workers were successful in obtaining indexation of past inflation, which sometimes is the case, Then they go to the second step, which is the negotiation in terms of real wage increases. So I will show the results for both processes, and then I'll try to explain a bit what explains the differences. So this is the case where we don't have the bargaining. We see that inflation tends to be stable, and also we see the original Phillips curve being valid. When we move to the other case, we see that an increase in the in the bargaining power of workers, the fee parameter, leads to a trend in the inflation rate, which is a characteristic of the accelerationist Phillips curve. Unemployment would be below the NAIRU. And this leads indeed to the accelerationist Phillips curve becoming valid. So when workers' bargaining power is low, we still are in the validity of the original Phillips curve, but then when workers' bargaining power increases, we move to the case of the accelerationist Phillips curve. So just to conclude, what is interesting here is basically this last slide here. So maybe I had to go quickly, but basically the argument here is that, first, the heterogeneity in terms of wage and price adjustments can explain the nature of the Phillips curve. And second, what we may be seeing now, which is this transition from the accelerationist Phillips curve back to the original Phillips curve. In the US, there is a discussion in terms of that. In Brazil, it's a bit more complicated, but we see this discussion in the US. This can be associated with a decrease in workers' bargaining power, which has led most wage adjustments to be insufficient in terms of full indexation of past inflation. And then in the macro data, we observe the original Phillips curve. So that's it. Sorry if I had to rush, but thank you.
We have a few data in the X, and particularly the comparison that compares how different countries develop under the present. Was quite important for a while. It's very important today. But it's a big debate on the literature, so we like to add some understanding about that, proposing a model that is able to capture some of the benefits, particularly the technological benefits of using stated now that enterprises as policy agents, as part of the policy toolkit to promote development. Okay, so that's this model objective. There's a lot of letters here, so let's try to put it through. But the big point here is that state-owned enterprises, or so is for the sake of shortness, are a policy instrument, has been a policy instrument in several countries. China, Brazil, have a long tradition, for instance, and others, have a long tradition. Italy, even Italy in the past, not nowadays. They have a long tradition on using state-owned enterprises as a way to promote development, to accelerate or catching up with more developed countries. But in the literature in the past 20, 30 years, the literature stopped to base, particularly in the West, the literature stopped discussing this kind of subject. So the idea here was, okay, let's take a look on this. Let's see if we can find some, let's say, at least theoretical justifications for still employing this kind of policy agent. Now it's becoming more popular again on the set of policies that you do for as part of the industrial policy for development of a developing country. Okay, and this has become more and more common, particularly because industrial policy is no longer a taboo. So it's, if you go to the US, you go to the UK, the US less today, but until very recently, and in the EU too, we have a lot of industrial policy action going on. So maybe we can take out this last taboo, and including in the mix of industrial policy, state-owned enterprises. So that's basically our objective here. We don't have a lot of data to do this kind of analysis using current data. There is data, but typically from the past. There are some data from China, but China is a very specific country. So our idea here was to propose to you a prospective agent-based model that is able to replicate a reality that we still don't have on most countries and see what would be the effect of this kind of policy agent in a more, let's say, micro-founded setup. Somewhat similar to what Lilian presented to us to deal with the labor market, we are proposing to use a similar framework to study the effects of state-owned enterprises being used as a way to accelerate industrial transformation. So basically, what we want to check is that if we go beyond the idea of taxation or supporting trading as a tool for industrial policy, we are thinking of the government selecting some agents to be, let's say, drivers of technology change, particularly accelerating the technology change in key sectors. Okay, so that's what we are trying to model here, and then we try to model state-owned enterprises and policies that try to mimic this in an artificial world that is created in our ABM. Okay, and then on top of this, we want to see the outcomes of that, both at the industry level, both at the technological side, but also at the more general macro level, in terms of employment, in terms of growth, in terms of balance of trade, and so on and so on. Okay, so we are proposing an ABM that has basically two countries. We have two countries in this setup, one developed and the other one developing. They have not many on purpose. We didn't make very different countries. We try to have countries that are relatively similar. So I would say we have an advanced developing country. And the main initial difference that we create between those two countries is the education profile. In a way that the advanced country expends more as a share of the GDP in education than the developing country. Okay, of course, over time, other differences will emerge, but they are endogenous to the model. So the only thing that we exogenously impose to the models as a difference between the developing and developed country is basically the level of education of the labor force. So in the developed country, you have more engineers, proportionally more high-level technicians, proportionally than in the developing country. That's at the startup, that's the main difference between the two countries. All other differences emerge as a property of the model that we are offering to you. Okay? And then basically the state-owned enterprises that we focus here are the ones in the south that produce machines. Sorry, we focus on the capital goods sector to promote policy there in a way that supports more, let's say, innovative machine producers. So how the government intervention happens? Basically, the government says, look, we have some good small machine producer firms, and we will help them to grow. How? Taking when they have financial problems, acquiring them, and then supporting those, let's say, already innovative firms with state funds and guarantees for looking for credit around and etc. So they become stronger financially in a way that they can not only survive, but they are able to acquire and access and accelerate the development of the technology they embed in their machines. And this diffuses over the rest of the economy, because the rest of the economy buy machines. So a country that produces better machines end up being having the development accelerated in all sectors because of the diffusion of the improved machines, and also because of the exports of those better machines to the other countries. All this is modeled in this setup. So basically, this is how the model we have organized. Is not super different from the one Lilian presented to us. The new things here that we play a lot, the difference between the two countries at the beginning, are in this education level, as I said. So basically, our workers have 3 levels. There are sub-levels, but mainly they have 3 levels of capabilities in terms of how technically prepared they are to produce. And those workers feed the entire national economy, both on consumption and capital good firms. And this share you have between them and the number affects the relative performance of those sectors. So it's not just that I can put money, let's say, for capital firms to develop it faster, but if I don't have, for instance, enough engineers to fulfill the positions, this money cannot be fully, let's say, exploited, because you cannot hire enough R&D engineers, for instance. So all this is modeled. So it's not a naive thing that say, look, put more technology here, this automatically improves the country. But there is this strong balance that, okay, I can put more money here, but I cannot change this profile very quickly, as fast as I can help this sector to maybe have some better firms. So that's why the government decides as a policy not to buy big companies that will require a lot of engineers, but to buy smaller companies that are maybe financially weak, but they are technically advanced, and try to make them to move faster. Why? Because those things don't need a lot of people. So they just need a few more engineers to keep going. Sometimes they already have the engineers. They just have to have enough financial, let's say, capabilities to survive for long enough while their machines are diffusing, are getting known through the firms in the country and outside of the country. So that's the challenge the model tries. Okay, so I won't bother you with equations, but basically, as I said before, we have 3 levels of education generally, but in details, every worker has a certain level of education, counted in terms of, to make it simple, in terms of number of years of schooling. So typically workers can have from 0 to 16 years of schooling, more or less corresponding to how many years you stay in school. 16, you finish university. If you have less, you may have partial university, complete superior middle school, partial, and so on. And all this affects the way they produce. And firms, when they hire, depending on the technology they use, they need different mixes of workers. So if you use more sophisticated machines, you start to have need a mix of workers more focused on higher level workers. So you need more engineers, you need more technicians, and you need less, let's say, first degree workers, and vice versa if you use lower technology. So this really puts a drag on less developed countries, because as they don't have the, let's say, the critical mass of workers to really move fast to newer technologies. This has to be an incremental process over time. And the only way for the government to have more money on education so they can have more engineers, move the division of education to higher level workers, is having a larger budget, having the economy growing faster so they can collect more taxes and apply more money in education. So there is a kind of vicious cycle that may emerge, and then the country has to overcome that if they want to really catch up with the North country. Okay, we call this North and South country as a reference. So North are developed country and the South are the developing country. Okay, that's it. There are also skills, all other stuff that we had in our preview labor market models are still there. I'm not detailing them because we already presented this several times, but of course, the detailing on the labor market goes much further than just education. But education was the new part added in this version of the model. The second thing we introduced for this particular study, it was we opened the international trade. So now firms trade both consumption and capital goods. So you can export machines, consumer products. There are several rules to handle that. And there is also for setting international prices. And also we have now different exchange rates. So countries that have their own currencies, and there is an exchange rate between the currencies of the two countries. And this evolves in a way that is floating exchange rate, and it floats according to a rule that takes into account the trade balance or trade unbalance. So a country that has a deficit on trade balance tends to have a devaluation in its currency as it is usual. But so the country, when is lagging behind, also has the typical problems that developing countries have of balance of payments, of having a weak currency, and all this is now modeled in the model in a very simplified, stylized way, but is already considering this discussion on how to catch up with state-owned enterprises. What else? This is how the mechanism in practice works, how the government selects firms to be acquired and to be sponsored directly sponsored by equity, sponsored by the state. So the government, every time it sees a firm that's weak, close to leave the market because of financial reasons, but has a strong technology when compared to the market, it may decide to step in and acquire the company. And then if it decides according to certain parameters, and if they acquire the company, they have to basically recapitalize the firm, to put new money on the firm, so it pays the outstanding debts that firm may have, and also add some new capital, and provide bank guarantees for future loans that this firm may get from the banks. Because after the initial takeover of the firm, the government let the firm work as a regular firm. The only difference after acquisition is that the government provides a guarantee to the firm. So the debt of this firm that is owned by the government is guaranteed by the government. So there is no risk for the bank to lend money for the state-owned firms. Other than that, and this initial, let's say, capitalization, there is no difference between private and public firms. They compete on the market the same way, they develop new technologies the same way. So the only difference is on this financial dimension of the firm. Okay? So what do you get? So we play these guys to work. So have two countries, different education profiles. The country that is in the south typically is performing worse than the north country. So this is basically the picture on some indicators of how before the policy, because introducing any state-owned firms, so we call the no policy scenario, how the two countries were performing. The black one is the north country, and the blue one is the south country. So if you see things like GDP and etc., you see a slow divergence in growth rate. So the black line there is the GDP. You see that slowly, even if they start from the same point, just because of the different endowment in terms of human capital and the ability to change this distribution of knowledge inside workers, you see that slowly the advanced country opens up, grow faster, and the gap between the GDP of the two countries increases. Here is a more detailed metric of the gap on GDP. So you clearly see that this is the difference between the GDP of the two countries. So this is just a symmetric of the other. So the advantage of developed country not only increases over time, but increases in an accelerated way. This basically follows what we know about this on the real thing. So basically, because of GDP growth, the developed country is significantly higher over time. So this compounds over time, even if the difference is not super big in terms of a single year of growth. Over time, this creates this divergence. And at the same time, the two countries have the same, let's say, fiscal system. So they charge the same taxes in percentual terms, and etc. What happens? Because this grows faster, government here in the South country has always a more, let's say, pressed budget. So the government debt in terms of GDP is significantly higher also in this. So the government has limited space really to change this situation because it doesn't have enough income to change the education distribution. So this creates a kind of lock-in. So it's difficult just to say, okay, if I put more money on education, but okay, I already have a very strict high debt and there's a very constrained budget. So how can I spend the money I need on education? That's a typical question on developing countries. Some other numbers to show the asymmetry. I don't have the time to enter in all of them, but also in balance of trade, the North country has the positive side, the South country has a deficit in the total transactions between machines and goods as we normally use it. The exchange rate of the developing country is devaluating over time, constantly. It relates to the currency of the developed country. And this creates a certain pattern of specialization over time between production of machines and consumer goods that over time focus and goes to a single country. That's a property of the model. Over some time, the countries specialize. The North specializes in consumer goods, and the South, that's not a super South, but is a lagging behind South, specializes on machines. That's what happens in the model when we have no policy. And then we introduce policy in the way that now some machine producers are acquired by the state, but not so many. This picture just shows you the share of the machine producers in the developing country that are acquired by the government. So the maximum size of in terms of market share of the state-owned companies is 10%. So at the peak, the government owns 10% of the capital machine goods that they statize it. But endogenously, after some time, the government stops this. So this lasts about, in quarters, so about 20, 30 years, the government ends up endogenously stopping acquiring new firms. Why? Because you don't have good firms getting financially problematic to be saved. It's not because we have a rule that says, no, now you stop buying. No, they could keep buying the entire period. But if they start statizing those firms here, they got an enough number of firms that are sound and good, and you solve the problem of financial solvability of these firms. That's the first interesting thing we discovered that. This is the same figure in terms of distribution. So when we introduce the new policy, you may have this, in average, in median, you have 6% of state-owned firms. And what happens, this is very interesting, there's the same pattern we saw of specialization. Just with this 10% of firms being held by the government and keeping the newer technology not dying because the firm died, but going ahead, the transition for specialization in the country happens as before, but happens earlier in terms of the market for machines being captured by the developing country. And interesting, it takes much longer for the developed country to dominate the consumption good market. Much longer. If you remember, it was around here. So it increases a lot the capabilities, not just of the firms that produce machines, but also for the firms that produce the other goods in the economy. So this is small number of firms are able to really change over time the structure of production in that country. And last one, to finish the data and then to go to the conclusions. If you see at the macro variables, you also see, you start to see a very different pattern in terms of the GDP. What we have here, no, sorry, this is not what I want. No, this is not what I want. Let's focus on those two, and I think is in the next one. So here you see the real wage. These charts don't compare countries anymore. They compare the previous, in black, the previous situation before the policy, and the blue is with the policy. So in the black is, if I don't have, South country is always the developing country. If I don't have the policy with state-owned firms, and in blue, if I do have the policy. So you see for growth, GDP, you clearly have a big difference because just that's those 10% of firms for some time. You see that forever you create a possibility of this country to catch up faster in terms of GDP. So this is not comparing the two countries, it's just the South country. Here you see productivity, basically where this GDP grows from productivity. So these new firms that don't die, the government keeps them safe, are enough to spur the productivity and so the GDP. And this also affects proportionally, or even more than proportionally, real wages, because this creates better conditions for the government to finance that, so they can put more money on education, so they can get more engineers, so you have more engineers, you have better wages, and then this improves also the average real wage. So you have these dynamics where government debt reduces significantly, and it allows the government to. That's basically wrap up the conclusion. Okay. So here you have the same data. Thank you. Compared for the two countries, but I will skip that because I think it's too much. So to finish, it seems that state-owned firms can be used, at least theoretically, for industrial policy making. And the potential for that, it doesn't require those huge, because normally people say, look, you want to create large public firms that need billions. No, we are talking about very light touch statization of firms. You are taking small firms that will be going out of the market likely because they have no financial capabilities to survive, but they have good technology. You take those firms, and then later on, you let them go. You don't have to keep them forever. You don't have to have the large majority or statize your market. You just have some, what you call technology carriers not leaving the market. This is the key message that the model shows us. Keeping the good firms not out of the market because of financial problems, because technology takes time to develop, takes time to diffuse, takes time to get known by customers. And this requires patient capital. If the capital that provides money to your firm comes from the bank, this capital is not patient enough to allow you to catch up, even if you have good firms. So there, it's very important that you provide some support network to those firms. And so it's not the typical state-owned enterprise of the past, but it's a new kind of state-owned enterprise that's technologically dynamic. It's firms that can really make a difference if they keep alive. So that's our conclusion. Thank you. Not really. Our focus is on the firms, to keep good firms not getting out of the market because they don't grow fast enough. Education comes endogenously automatically, because if the government has more money, he can put more money on the education. So basically, this is indirect. I don't change a single parameter in terms of education or how education was before and after the policy. So no, I don't believe it's an education policy, even if the model does education policy as the government has more funds to put on education. But this is endogenous. I didn't change between the two scenarios. So in the first scenario, if they have fiscal space, they would have invested in education the same as they did in the second scenario. So the policy itself is about keeping those future unicorns alive, so they don't die before they become a unicorn. Okay, so that's the conclusion we got. One more, please. But the point is, The emergence of state-owned enterprise is endogenous in the way that the government opens a policy. If certain conditions are met, I can statize some companies. Education is endogenous except because this is a political level, how much of the GDP I want to invest in education. So this is exogenous. So we say, and we took this from empirical data, okay? This is about what we see in reality, that good developing countries put 4% of the GDP in average in education, and advanced countries only put 5%. The difference is slight, and we are not changing those numbers. Of course, if I put more than 4, it would be even better. But the point is, as the GDP increases, even if I keep 4, I keep putting more money on the education system, and I start to change the proportion of engineers, because all this distribution of the money is endogenous, is model endogenous. So that's why you keep it exogenous. It could be endogenized, but that would be a political cycle.
It's a pleasure to be here, and different of my colleagues here before, I will present, I have to synthesize a class that I use to teach my students. I use it to teach 2 classes about this subject, and I try to compact this in 25 minutes and to talk about not about a model or an agent-based model, but I think what we'll do with this kind of model, and what kind of economic science we are manipulating, or we are creating, something like that. And I think the main idea here is to comprehend what we mean about complexity in economic science and into the ABM models also. And then I put this title, why ABMs, and more than ABMs, complexity can take economic science further. I think, Andreas, you know this history better than I. This history and about it's a presentation about more about the ontological and philosophy of economic science and complexity than some more specific model. Okay, I will present something. I will resume my presentation in a world dream, this second part here, and then I will move fast to why we use complexity in economics. And the idea is that we can comprehend, especially I think I asked Marcelo before the presentation, who was the audience, and then he told me that there are many students starting the PhD program here in UNICAN, and then maybe this presentation could help you to enlarge the visions of a new kind of economic science. And I don't know how much, I don't know, Andreas and Roberta, where is she? Who else don't speak Portuguese in this room? Just Andrea. Andrea understand how many years you came to Brazil, no?
Sete carnaval.
Yeah. And then if you agree, I would be more familiar to present in Portuguese, okay, the idea. And I will speak slowly. In a way that you can understand that. So let's go. Introduction, okay. The motivation is about 2 guys, I think it's acho que 2 físicos renomados aí do século XX, né, que tiveram alguns vislumbres sobre o que poderia ser uma ciência no século XXI. Diferente daquela ciência newtoniana, né, baseada em cálculo diferencial, integral, que a gente foi construindo ao longo do século XVIII, XIX e XX. Né? Então, Stephen Hawking deu uma entrevista num jornal, 2000, e falou que ele achava que essa ciência da complexidade, seja lá o que isso venha a significar, né? Na cabeça dele acho que estava mais claro do que talvez na minha, quando comecei a estudar isso, seria um novo padrão de enxergar a realidade, lidar com os problemas da realidade, completamente diferente. Então ele achava que isso poderia ser as bases da ciência do século XXI, assim como a física newtoniana tradicional, a física clássica e tudo mais, até mesmo a física essa física quântica, né, acabou sendo, né, por trás dessa ideia de complexidade existe muita coisa que é difícil de enxergar, né, e essa acho que é a riqueza do que a gente vai fazer. E até mesmo Einstein, né, já tinha noção de que a gente não consegue simplificar muito as coisas a partir de um certo nível, né? Se eu tentar simplificar mais, eu destruo o próprio sistema que eu estou estudando, eu destruo o objeto de estudo, né? Porque ele possui algumas propriedades para existir. Daí eu vou mostrar uns exemplos aqui em economia, que eu acho que pode ajudar a gente a entender, por exemplo, como que a gente lida num ambiente econômico que está sujeito a transformações tecnológicas, por exemplo. Né? O que é uma inovação tecnológica e seus possíveis impactos. Um outro camarada, né, que uma certa época ele entrou numa seara de uma briga religiosa, aí, né, depois parece que ele abandonou isso. Ele escreveu um livro muito interessante que eu recomendaria para os alunos todos, The Blind Watchmaker, ou seja, o relojoeiro cego, em que ele diz assim, e isso tem muito a ver com a física newtoniana, não é à toa que ela teve grande repercussão, né, na ciência como um todo. Our brains were designed to understand hunting and gathering, matching and shield hearing. Ou seja, a world of medium-sized objects moving in 3 dimensions at moderate speeds. É exatamente isso que a derivada faz, né? A gente calcula a variação de uma atividade, a taxa de crescimento da inflação, a taxa de crescimento do PIB, tudo mudando, e os nossos olhos, os nossos equipamentos sensoriais foram construídos evolucionariamente ao longo dos milênios e milhões de anos para perceber esse tipo de movimento. Então, o desafio da inteligência artificial hoje está em saber fazer um carro entender se tem algum objeto passando ali, aquilo lá é uma ameaça ou não é. Né? Nós fazemos isso muito naturalmente, porque o nosso cálculo mental que nós já fazemos já está computando, né, esses objetos se movendo em larga escala. Porém, certos movimentos de longo prazo nós não enxergamos. A nossa mente não está formada para isso. Então, quando a gente estuda, por exemplo, mudança estrutural ao longo de 100 anos, né, na economia, nós estamos tratando de mudanças que não são visíveis o tempo todo. Né? A gente tem que abstrair muito para conseguir alcançar aquelas mudanças. Tá? Então, esse aqui é um exemplo simples, né, de como é que nós desenvolvemos modelos, seja ele em formato contínuo, ou seja ele em equações em diferenças finitas, como a gente usa em ABM. Né? Então, de certa forma, muitos ABMs que a gente desenvolve, eu passo 80%, 90% do meu tempo escrevendo códigos, modelos baseados em agentes. Né? Então, eu faço isso. Né? Mas eu também sei que alguns desses modelos, eles estão filtrando muito certos aspectos da realidade. Né? A questão é que, historicamente, né, era para nós termos uma ciência econômica já muito evoluída nesse aspecto evolucionário. Mas nós perdemos isso historicamente, não só pela prevalência dos neoclássicos, mas por alguma coisa que aconteceu um pouquinho antes da emergência dos neoclássicos, né, ou do pessoal que Valras, Cournot e tudo mais, né, que começaram a desenvolver uma ciência usando o cálculo, porque era também o instrumento que eles tinham na época lá. Então, imagino que se tivessem computadores fazendo cálculos em larga escala, com processos evolucionários, com tomadas de decisões, com interação entre os agentes, tudo mais, a história seria outra. Mas foi dessa forma. Né? Então, nós deveríamos ter tido uma ciência ao longo do tempo que ela poderia ser, né, que ela, no seu nascimento, ela foi histórica, plural, indutiva, sintética, dinâmica, fora de equilíbrio e evolucionária. Ela tinha todos, havia argumentos lá em Malthus com essas intenções, ou com essas dinâmicas, ou com essa visão de como a realidade funciona. Mas, em algum momento, a gente se transformou numa ciência analítica, estática, mecânica, dedutiva, rigorosamente matemática, né? Então, os nossos modelos precisam ter soluções analíticas, né? Eu preciso calcular isso, tem uma certa vantagem em usar esses modelos. E, mais importante de tudo, a gente jogou fora esses aspectos de uma ciência complexa e trabalhamos com um mundo que sempre está tendendo ao equilíbrio, né? Algumas metodologias modernas, inclusive, partem do pressuposto de que as coisas convergem para um equilíbrio, né? Então, essa história, assim, ela pode, antes dos chamados aí neoclássicos, a gente tinha duas coisas interessantes, né? Assim, duas grandes visões assim na biologia. Todo mundo já está mais familiarizado com Darwin, mas poucas pessoas estão familiarizadas com Spencer. E eles são contemporâneos, né? Um do outro, Spencer e Darwin. E eu acho que quem está por trás do Darwin ainda é o Malthus, que é uma coisa pouco percebida. Depois eu vou mostrar uma frase do Malthus ali, né? Então, os dois aqui, Spencer e Darwin, eram biólogos. Em algum momento, lá atrás, a ciência econômica começou sendo pensada como também uma biologia aplicada à sociedade, ou à dinâmica da organização dos mercados e tudo mais, né? Só que a visão do Spencer e Darwin eram bem diferentes, né? Em um certo sentido, prevaleceu a ideia que especialmente Marshall, Walras, pegaram de Spencer, a ideia que o Spencer via, né? Como que a sociedade evolui, ou a natureza e a realidade evolui através de um movimento harmônico que tende a um equilíbrio. Então, a teoria da evolução não é de Darwin. A teoria da evolução é de Spencer, não de Darwin. Darwin não usou a palavra evolução na origem das espécies, né? A teoria do Darwin era uma teoria sobre como que as coisas mudam, não necessariamente evoluem. Né? E a concepção de Darwin era diametralmente oposta de Spencer, porque ele dizia assim: a evolução ela não tem uma intenção prévia. A mudança das coisas, mesmo na nossa sociedade capitalista, apesar de a gente controlar certos processos de inovação, dominar isso politicamente, geopoliticamente, a gente está vendo o que o Trump está fazendo no mundo hoje, mas muitos desses desenhos de sociedade eles não estão já previamente organizados em algum esquema idealista, né? E isso é muito mais resultado da emergência de determinados padrões e características sociais, né? do que simplesmente uma adaptação ao ambiente como era a visão do Spencer. Mas o que predominou na economia foi essa rota, digamos assim, que vem dessas teorias biológicas, que depois encontraram ressonância no que diz respeito à existência de equilíbrio e tudo mais, nesses utilitaristas, né? O interessante é o que acontece com esse dinamismo, né, tal como pensado inicialmente por Malthus, daí o Malthus influenciou Darwin. Então, vocês verem a diferença de concepção, né? Spencer. O Spencer já tinha um certo pensamento que hoje a gente usa, inclusive, em alguns modelos complexos, algoritmos genéticos, por exemplo, né, essa questão da sobrevivência do mais robusto, do mais vigoroso, né? Então, esses processos de otimização, quando você não conhece onde é que está o ponto ótimo, que esses algoritmos genéticos fazem, normalmente eles avaliam uma função, uma espécie de uma função utilidade que produz um certo fitness a partir do momento que você sofreu uma mutação e daí vai passar por um processo de seleção ali, se aquela estratégia é mais adotada ou não. Já vi um monte de papers, né, selecionando, os agentes escolhem estratégias evolucionariamente a partir de e avaliam a eficácia dessa estratégia por alguma função de fitness. Então essas coisas não são novas, como a gente pensa que é, né? E dizia o Spencer, I propose in the first place to show that this law of organic evolution is the law of all evolution. Aqui é que está o ponto interessante. Se ela trata do desenvolvimento the development of the earth, the development of the life, the development of society, the development of government, of manufactures, of commerce, language, literature, science, art, and so on. Ou seja, a evolução que está por trás de toda a organização. E o que nós mais temos dificuldade na ciência econômica hoje é lidar com a evolução, né? Então, os meus modelos que eu faço, eles são muito pobres nesse sentido de evolução. Porque o máximo que eu consigo colocar lá de uma mudança tecnológica é um parâmetro de produtividade que tem uma função de distribuição com uma probabilidade lá X qualquer, né? Mas eu comecei a estudar um pouco mais, tentando desenvolver alguma coisa que seja criação de novos padrões a partir de coisas que já existem, e não simplesmente, digamos assim, um aumento só o aumento da produtividade, porque isso, se explica alguma coisa, não explica um monte de outras coisas que nós precisamos estudar, né? Então, a diferença entre essas ideias de Spencer, que acabaram predominando lá no início da formação da ciência econômica, quando comparada com Darwin, ela é muito diferente, né? Então, o Spencer partia de uma ideia de que as coisas, nas diversas dimensões, seja natural, social e tudo mais, elas é um processo de adaptação ao meio ambiente. Essa é a direção pela qual a evolução acontece. Existe alguma coisa no plano macro e as espécies, ou os agentes, ou as entidades vão se adaptando, né? E à medida que elas se adaptam, sem saber exatamente qual é o mecanismo, elas transmitem esses novos conhecimentos ou essas características adaptativas para novas gerações, né? E aí o Spencer tinha uma teoria da evolução que ainda influenciou muitos economistas, né? Tem um paper bem interessante, escrito em 1950 por um cara chamado Alkian, com certeza, Evolution and Economic Theory, que faz uma distinção entre adaptação e adoção de novas características hereditárias e tudo mais, né? Mas quem realmente explicou qual é o processo de mudança, como que a mudança acontece, foi Darwin, que descreveu a teoria do Darwin. Então, não é uma teoria sobre evolução, é uma teoria sobre a mudança, propriamente dita. Então, ele olhou para os indivíduos, ele olhou para os agentes e viu, bom, como é que esses caras mudam, como é que eles evoluem, não propriamente como eles evoluem, mas como eles adquirem novos conhecimentos, como que eles se organizam e transmitem isso para futuras gerações. Então, ele estabeleceu uma teoria da mutação, da seleção e adaptação e a transmissão entre gerações. Então, se existe um mecanismo de tentativa de se adaptar ao novo através de mutação, existe na sequência, bom, essa mutação, a princípio, eu não sei se ela é eficiente ou não, no sentido econômico, eu não sei se é uma estratégia que vai aumentar meu market share no mercado, né? Mas eu vou então rodar, né? Eu vou passar a operar no mercado durante um tempo com essa estratégia. Eu tenho uma função de fitness lá que avalia os resultados dessa estratégia, e se ela for adequada, eu transmito isso para as novas gerações, e aí a minha espécie sobrevive em detrimento de outras, né? E aí eu tenho um mecanismo de adaptação. Mas o que o Darwin descreveu foi como que isso aqui acontece, o que não tinha na teoria da evolução. Então, para Darwin, o que a gente chamaria aqui de environment não é simplesmente a causa da mudança a nível individual, né? Então, assim, não é o macro que determina o micro, né? Senão uma interação entre essas duas coisas constantemente, né? E a gente, muitas vezes, a gente acaba desenvolvendo alguns modelos, assumindo, talvez até com propriedade, mas quando a gente faz isso inconsciente é um problema. Quando a gente faz consciente que eu estou fazendo aquilo, eu sei, porque eu adotei isso como pressuposto, né? De dizer assim, ó, os meus agentes vão se adaptar a algum choque macro, né? Ou alguma variável macro, ou algum conjunto de variável macro. Mas eu me lembro uma vez que eu estava num encontro desse tipo ali, estava lá do Rio, o Mário Poças, com aquele jeitão dele, né? Ele falou assim, olha, nada acontece no mundo macro. O mundo macro é a sombra, a projeção, ou modernamente a emergência de um monte de coisas tramadas individualmente no comportamento dos agentes. E quem mais conseguiu levar a ciência econômica adiante, modernamente, são esses modelos ABMs, que são muito mais ricos em microfundamentos, né? E acho que a apresentação, não sei se foi da Roberta ou da Lilian, em que ela começou, olha, dado um padrão macro, eu quero saber quais são os microfundamentos que geram, né, a curva de Phillips, né? Então, a coisa, né, acho que ela é rica em termos de permitir pensar, né, do micro para o macro, do macro para o micro, mas sobre um processo que está continuamente modificando. Bom, qual que era, né, a influência? Se vocês olharem as datas aqui, né, o Malthus divulgou suas principais obras em 1819. Darwin, a data do Darwin foi 1860, 70 anos depois. Eu não tenho a data do Darwin aqui, quando ele publicou A Origem das Espécies. Em 1859, né, então já deu 40 anos de defasagem entre Malthus e Darwin, mas para Malthus, que era, digamos assim, alguns dizem assim, ó, se o Adam Smith teria sido, entre aspas, o pai da economia, o Malthus deveria ser o avô, né? A principal causa de erro e de diferença da qual prevalece até o presente entre cientistas e economia política, me parece que é uma tentativa, uma precipitação em simplificar tudo e generalizar demais, né? Então, tem um biólogo mais recente, Ernest Mayr, que resgatou um pouco essa ideia de introduzir na ciência como um todo a ideia de como lidar com variedade e diversidade, que é uma coisa que hoje nós temos muita dificuldade de fazer isso na economia. Então, eu tenho que acelerar. Acabou que nós nos transformamos numa ciência que não é uma ciência, digamos assim, autenticamente evolucionária, mas isso tem mudado mais recentemente. Então, tem vários exemplos. O mais eloquente é esse paper de 1898 do Veblen, em que ele já reclamava, né, que já estava angustiado de por que a economia não estava sendo uma ciência evolucionária e se transformando numa outra coisa, né? Bom, então a gente acabou caindo aí numa economia mecanicista. Eu achei, assim, eu fui atrás de algumas coisas que exemplificavam como é que foi essa teoria. Esse aqui é um modelo que o Irving Fisher publicou no periódico, a Mathematical Investigation, em que ele usa a metáfora da hidráulica como sendo maneira de modelar o sistema econômico como um todo. E aqui as representações que estão no paper original são exatamente isso, que são compartimentos de água, né, são bens que um consumidor vai consumir, em que se ele aumenta a quantidade do terceiro, daí ou diminui aqui, vai aumentar um outro conforme as conexões e tudo mais, tal. Aqui é a mesma coisa, você tem possibilidades de injetar recursos aqui por fora, por esses dutos, e isso vai mover uma engrenagem lá dentro, assim como a gente moveria um mecanismo hidráulico. Aqui não apareceu. Aquele computador que foi construído em 1949, que não era bem um computador, era uma máquina grandona, acho que todo mundo, não sei se vocês já viram isso ou não, tem um filminho na internet lá, que era um computador que você via a água circulando, e a água é a política fiscal, política monetária, quantidade de moeda em circulação e tudo mais, etc. e tal. Em certo sentido, a gente continua usando isso, mas não mais com água, mas com equações em diferenças finitas, né? Por exemplo, com choques aleatórios. Então, o exemplo mais eloquente disso são esses modelos DSGE, que não se diferenciam muito metodologicamente, assim, ontologicamente eles se diferenciam, mas computacionalmente muito pouco, porque é um conjunto de equações em diferenças finitas que recebem em algum lugar aqui algum choque aleatório, que seguem um certo padrão de uma distribuição de probabilidade. A diferença é que, por concepção inicial, esse cara aqui vai convergir para um equilíbrio, né? Os modelos ABMs não têm essa restrição, podem convergir, mas podem não. Quando eles não convergem, nós temos um problema, né? E uma coisa interessante, porque nem tudo no mundo converge por equilíbrio, mas se ele não converge, tem que explicar o que está acontecendo, né? Então, essa emergência de novidades, aqui nunca vai emergir alguma coisa diferente, né? Nesse tipo de modelagem aqui. E eu vou pular um pouquinho, né? Aonde que está a complexidade daquilo que nós estamos estudando? O conceito básico assim, dessa palavra complexidade vem do fato de eu permitir que um conjunto ou um largo número de entidades simples ou de agentes, tomando decisões descentralizadas, conseguem produzir a nível macro alguma ordem ou algum padrão emergente, né? Só que quando a gente olha os agentes, você não percebe que tem neles aquela estrutura macro. É isso que eu quero explicar um pouquinho, eu não vou entrar em muitos detalhes ali. Tem uma definição interessante desse matemático húngaro, que é a ciência da complexidade sugere que enquanto a vida está em acordo, né, com as leis da física, a física não pode prever a vida. Essa mudança da relação de causalidade é alguma coisa que diz assim, bom, então tá bom, então como é que eu explico certos tipos de sociedade que existem, certos padrões de mercado e tudo mais. O exemplo mais eloquente é um cara que veio pesquisar formigas na Amazônia, acho que não sei se todo mundo viu um livro da Melody Mitchell sobre complexidade. A experiência era assim, eu joguei uma população de formiga dentro de uma área cercada, tinha uma fonte de alimento, as formigas, uma quantidade pequena de formiga começou a andar em volta à busca de alimentos, algumas achavam, outras não, ao final todas morreram. Aí ele aumentou a quantidade para 1.000 formigas, elas continuavam andando, a partir de um determinado momento morreram. Daí ele aumentou para 10.000, o número não lembro exatamente, a partir de 10.000 população, aquelas formigas conseguiram se organizar em um formigueiro, alteraram alguma lógica de funcionamento, e aí emergiu do mesmo tipo de comportamento, 100.000 ou 10.000, do mesmo comportamento, uma hora emergiu uma sociedade, pequena, simples, de um formigueiro. Aquela sociedade, aonde está ela? No comportamento individual da formiga? Não. Ela está em alguma relação entre o micro e o macro que possibilitou o surgimento de uma coisa inesperada. Então isso começa a acontecer, por exemplo, o que a gente quer dizer assim, é que a ordem certos tipos de ordem podem emergir de diferentes... Cadê a parte de... Tinha uma figura aqui. Então, assim, qual é o tipo de ciência que nós fazemos? Fazemos ciências com equações matemáticas, né, digamos assim, analíticas, por exemplo, né, Eu vou calcular o PIB agregado, então eu simplesmente somo os PIBs individuais de cada firma, de cada setor e tudo mais, e agrego. Se eu quiser tornar essa economia criativa, no sentido schumpeteriano de criação e destruição, eu flexibilizo o limite superior e inferior dessa integral, e aqui eu estou criando novos produtos, eu estou aumentando o limite superior, eu estou destruindo, eu estou diminuindo, eu estou aumentando o limite inferior, e aí eu tenho um processo de criação destrutiva. Mas isso aqui ainda não foi incorporado em modelos analíticos, né, até onde eu saiba. Mas o que acontece? Quando eu aplico esse tipo de somatório aqui, e eu pego um monte de pedra, aí tem a mesma coisa da formiga, né? E eu somo essa quantidade de pedras, eu vou ter uma certa tonelagem. Ou se eu transformar, cada pedra tem um certo valor, ou cada tonelada tem um certo preço, eu tenho o valor dessa quantidade de pedra. O que não está aqui, o que é o aspecto complexo dessa história, da organização da sociedade, e aí quando tu procura uma política industrial que está sujeita a essas coisas, a maneira como essas pedras estão colocadas na caixa vão dar surgimento a diferentes sociedades. E da onde essas sociedades vêm? As pedras são as mesmas, né? Aí existe uma intencionalidade, e é esta coisa por trás que é o que a gente poderia chamar aí da emergência de fenômenos complexos, né? Um exemplo disso foi essa invenção da máquina a vapor, que inicialmente, já vai lá, Marcelo, que inicialmente era para tirar água de uma mina de carvão, até que alguém teve a ideia de que se esses dois êmbolos sobem e descem, por que a gente não conecta uma roda aqui embaixo e faz girar uma roda? Se a gente faz girar uma roda, por que não, então, nós não podemos tirar carvão, lá em vez de tirar a água, a gente vai tirar o carvão de dentro da mina. Pois, se a gente tira o carvão, a gente pode transportar pessoas e mercadorias. E quando a gente transforma pessoas em mercadorias, surgiu a economia capitalista, oligopolista ou monopolista. Basicamente pela invenção desse tipo de máquina. Então, assim, a invenção propriamente dita, ou a difusão dessa invenção na forma de inovação, criou uma sociedade completamente diferente. Então, fazia todo sentido para o Valras, que nem nós aqui, colocar todo mundo numa sala, eu sou o leiloeiro, e todo mundo sabe o preço de oferta e demanda. Por quê? Porque está todo mundo no mesmo lugar. Quando aconteceu isso, a fábrica foi para a China e o mercado consumidor está aqui no Brasil ou em outros lugares. Por quê? Porque com essa máquina eu consigo transportar a mercadoria, fazer ela chegar lá com um certo grau de previsão, no tempo certo, sem problema de morrer o cavalo no meio do caminho. Pela primeira vez a humanidade conseguiu andar numa velocidade maior que a do cavalo. E aí essa tecnologia continua avançando, não mudou nada na sua essência, mas está causando uma revolução, por exemplo, que é a política industrial chinesa. Então vocês vejam que, assim, quanta coisa que existe fora das relações mais simples, né? E quando a gente está lidando, especialmente com o fenômeno de inovação e difusão, tem coisas que a gente não é difícil de prever para nós economistas. Então hoje o mundo inteiro está se debatendo para saber o impacto da inteligência artificial. Eu acho que para entender o impacto da inteligência artificial, eu já tentei fazer isso, né? Começar a pegar os dados da RAIS aqui no Brasil, que é a relação de emprego e tudo mais. Eu tenho lá 25 anos de dados empilhados da RAIS, para saber se quem está migrando de setores elétrico, eletrônicos, matemática, e indo trabalhar em setores de engenharia de software e coisas assim, para tentar ver essa migração de mão de obra. Mas eu sei que os impactos disso vão além dessa proporção de trabalhadores em determinadas coisas. Então, assim, para sintetizar um pouco a minha longa fala, os estudantes que estão aí começando a vida acadêmica, né, eu diria assim, que há um campo vastíssimo para os economistas entenderem o processo que nós estamos vivendo no mundo de hoje com essa tal aí de ciência da complexidade. Eu fico à disposição depois de todos aí para quem quiser indicações de literatura e tudo mais, que eu acho que assim, muito promissor isso. Então, por fim, calculemos, e é isso. Obrigado.